Bonsoir, mate. Welcome back. Welcome back. So what I've done here is included the summary of what we discussed today. So far, I introduced the idea of a model where adding debt will not increase the value of the firm. I had a number of assumptions. Then the key assumption being no taxes. So I allowed taxes to exist. And then the tax deductible interest payments added value as they created cost savings for the firm. So this is the added value in perpetuity. to the value of the firm. And then I had to temper that with the fact that we cannot realistically think that there's no default risk. So I brought back default risk, and that created a cost of default, or a cost of too much debt. And I explained this would be a function or some value that would kick in to offset the benefits of debt if there was too much debt. So those are the three cases we dealt with today. So given certain assumptions, and here you allow taxes, and then here you allow for taxes and default risk. And the conclusion was, I'm just reviewing what was said. The conclusion was that we could observe a function. Here. So we could observe a function where the value of the firm initially seems to benefit. The value increases with some debt, but then at some point, more debt reduces the perceived value of the firm. Okay? And we talked about the perception that the firm might fall into default risk, and then an episode of financial distress, and then bankruptcy, and all of those have costs. And that will take away from the benefit of additional debt. So we visualize a function like this, possibly, where we can maximize the value of the firm here, if we can find that spot. And this would represent the optimal level of debt. So with some tools and with data, you could attempt to construct a function. Theoretically, in reality, it could also be done. And then you could also imagine that this affects the cost of capital. So let's look at that. This is where we left off. So this is the change, this is the impact on the WACC. Now what we see is, this is the without debt. Without debt. In the levered firm, the unlevered firm is unaffected, right? This is the return. This is the cost of equity for the unlevered firm. This is the return to shareholders in the levered firm, and it is increasing. They recognize that they are at increased risk as debt is taken. They're at increased risk of not getting a payout of dividends. So they require a higher rate of return for every dollar invested. In terms of the average investor in the firm, the average investor in the firm begins to look more like a bondholder as you have more debt to equity. But at some point, even the bondholders at the optimal level of leverage, even bondholders will begin to predict that this is a risky investment, and they will demand higher return because default risk is possible. So this is going to go up, and as a consequence, with higher and higher levels of debt, WACC follows. Okay, higher levels of debt, WACC will look more like, the average investor will look more like a bondholder. So WACC follows this pattern. And that is it. So I gave you some exercises to practice. Let me ask if you have any questions first. Let's see if you have questions first. Any questions? Okay, no questions? All right, let's look at some exercises. So we begin with, what did I give you? 33, 34, 34 and a half, 35, 35 and a half, 36. This is document 34. And I have not changed the class, the course number, because I use these in other classes. So I apologize about having the class number wrong. So here we have the first exercise. This is document 34. So I'll give you a moment to locate it. All right, so when we say assume an M world, it's referring to all those assumptions. Okay, and this one with no taxes. So this is no taxes. This is the initial case. And you're told about the risk-free rate and the market risk premium, which is 10%. I could write it like this. I could write it, comes different ways. And then corporation could be financed with debt and equity according to the proportions specified in the table below. fill in all the missing cells in the table below. So we are going to use the results from the first case and results of proposition 2 regarding see, these are all the returns. Returns to equity, returns to debt, and then the betas. So we're going to use both cap M and the results of M and M to solve this. So again, this is an exercise to practice these relationships that we learned. Where should we start? Where should we start? Let's have a look at our results again. So in the first case, where there's no taxes and we assume the number of things, then the firm value, it has no effect to leverage. And I explained that an investor, it could be just as attracted to the unlevered as a levered firm. It could recreate returns if they invested in the unlevered firm by borrowing on their own account. So that's the result for the value. What about the WACC? Here's what we learned about the WACC. This is a very important result. This is on page 4. That these are the same. If the value of the firm is the same, whether it has debt or not, then the return to the investor shouldn't change either. So the average investor in the firm with debt should require the same return as the investor in the unlevered firm. So these are the same. So what does that do to our table? where is the WACC on this table? So these should be the same. This here, expected return to the firm, should be the same here and here as a WACC. But we don't have WACC. We just have this other information. So what should we do? Well, we have this information. We don't have the information on the return to shareholders in the all equity firm. So this is the all equity case. Okay. So if the firm is all equity, then the investors are just shareholders. So the WACC is just for shareholders. There's no bondholders. So this value should be the same as the return to equity. Now, how are we going to find it? Well, here is the beta, and we have the risk-free rate and the expected return to the market. So we can use CAPM to compute that. So let's make a calculation for CAPM. I'm going to enlarge this. Okay, so that's the capital asset pricing model formula. Let's see what we have. We know that this is 4%. We know that this is 1.2. It's here. And we know that this is 10%. Is it 10%? Minus 4%. Let me go check to make sure that's correct. Yes, it was 10%. So as a result, this is 6%. So 1.2 times 6%. So maybe you don't know what I'm doing right now, but we're going to work on this table so you'll understand better by the end. So the result is 0.76. Did I get that wrong? What do you get? Yeah, I got that answer too. Sorry. Very good. So this is 11.2. Is that correct? No, that's not right. That's not right. What did I do wrong here? 1.2 and 6. Let me go read that again. Oh, that's why. I did this before. It's not 10%. The market risk premium is 10%. So let me correct my interpretation here. This is not ERM. The market risk premium is 10%. I knew I was doing something wrong. Okay. So this whole thing, I give you this whole thing because it says market risk premium, not the market return. So that changes things. It makes it very easy to calculate. So that's 10%. So that makes me correct this here. And then you can see the answer. I hope that's okay, not confusing. Okay, because it says that they gave you the market risk premium, not the market return. Very good, monsieur. Very good. So let's put that number on our table now. 16 goes here. And that's the expected return on equity for the unlevered firm, all equity firm. But it's also the WACC, so it's also going to go here. So people who want to see the calculation, there it is. Okay, so we did one row. Let's finish. What would this be? What would be the weighted average beta of the securities? Of the securities for XYZ. Well, there's no debt, so there's no debt beta. It's all equity, so the weighted average beta is just the same as the beta for equity. So this is just 1.2. Because there is no debt. So we finished one row. That's good. What next? Let's look at the next row. If the firm issues 20% of its financing as debt, and 80% remains equity, this is the measure of the expected return. I give you the equity beta, so risk, the beta goes up. That's going to happen because the return went up. You see? The return goes up because of increased debt. So this will go up. The beta for equity will go up because risk and return increase in tandem. We'll say the debt beta is 0.12. Now let's see if we can calculate what's missing here. How could we calculate this value? The expected return on debt. Again, you can use the CAPM. You have information here on the debt beta, and you can apply the CAPM to find the expected return to debt. So this is 1.12. Let's use the same equation. And all I'm going to change is this is going to be, all I change is the beta. And the beta is, I'm told, 0.12. So now what do you get? It's very low, right? Debt is more less risky than stock. Okay, so expected return in WACC is the same, answering the question. One second. One moment, please. The rule here was case 1. The WACC was equal to the expected return because it's for an unlevered firm. So this is the firm with no debt. It's the same as the WACC with debt, as long as there's no taxes and all the other assumptions are in place. Okay, you guys are doing great. You're following along. So you did get it 5.2. So this amount, oops. So back to our question paper. This looks like it froze. Did my screen freeze? Oh, looks like it froze. 1 second. Yep, I lost the connection. 1 moment. I don't know what's happening. It is frozen. Hold on. Are we on? We're back. And my connection broke. Okay, so you calculated 5.2. You found out that the expected return on debt is 5.2%. Now, what will the WACC be? In Proposition 2, with no taxes, we learned that WACC will always be the return for the unlevered firm, the return to shareholders. This will continue to be 16%. And it's because the value of the firm and of the levered firm and the unlevered firm is the same, so the average investor in the firm should have the same returns as the investor in the all equity firm. Actually, this whole column will be 16%. No matter the amount of debt, this will always be the same, but what will change is debt. The amount of debt will change, and the return on equity. You see this changes. So let's just continue with this. Let's calculate the weighted beta. If the weighted average cost of capital is always the same, so this is our assets, right? This is what this represents. This is R to assets. And this is the beta of assets. And to go from return to risk, or risk to return, we use the CAPM. So because these are all the same all the way down, so too must these be the same all the way down. This is because of the CAPM. If I use this expression, Allow me to erase this. So if I use this expression, oops, this is the cap M. That looks really bad, doesn't it? Let me go back. Let me do it again. I'll just put this one here. So this is the capital asset pricing model. So if I just put beta of assets in here and expected return of assets in here, and this is always the same, it doesn't matter, for every different level of debt, this is the same thing. I'm always going to get the same beta and vice versa. So that's why they're the same. Risk gets mapped to return by cap M. All right, so what do we have left? So we did this row, so we're done that row. Next. So we can use the cap M for these. Or can we? We don't have beta here, so what do we do? How do we find this one? How should we find the expected return on debt? We have the debt beta, right? So we can do it the same as we did before. We just don't have the equity beta, but we can find that if we need to. So again, we return to the capital asset pricing model, and we're going to put beta, the beta of debt as 0.12 to get this. Now this is the same number we had before, so wouldn't these all be the same? Using the same formula? So these should all be the same. Is everyone comfortable with that? Same formula, same value for debt beta, so these should be the same. All right, so now this one, equity beta. How do I find this? Again, with the cap M, risk matches with return. This is the return here. Now these are going up. Equity, RS, this is RS in our model. This is RU, there's no debt, but the rest are RS. This one is RB. This one is our assets or WACC. This one is beta, S, and this is beta B. So how do I find the equity beta? Here, I use CAPM with this level of return, and I can find the beta. So 23.2. So now what I'm going to do is use this formula. I'll erase this row. I'm going to use this formula now to give you the expected return, the risk-free rate, and the market risk premium, and you have to find beta. So let's see, what numbers do we have? This is still 4%, and this is still 10%. I want to find beta I, and I know the expected return is 23.2. So to solve this, you would do 0.232 minus 0.04 divided by 0.1 is beta. So beta is equal to 1.92. So we just keep using the capital asset pricing model formula. Yes, very good. All right. Very good. So you see, we keep reviewing the capital asset pricing model. So this is good in anticipation of the test that we keep practicing. All right, so we've sorted that out. What's next? Very good. So now let's get this value. How do we find this value? Any ideas? You can't use the capital asset pricing model because you don't have the beta of equity to get the return on equity. So you can't use that. So what are you going to use? What should you use? So how shall we find that? No ideas? Let's go back to the notes and see. Look here in this box. This is the return to stockholders. Let's take that formula with us. So I explained that you can solve for that from the WACC. Now WACC stays the same no matter how much debt there is, but stockholders don't feel the same as the average investor in the firm. Stockholders will require a higher rate of return because now they are less likely to get a dividend like they hope. So there's the formula. Let's use this formula to compute the column 2. Oh no, BS is known. Look here. What is B over S? What is this? this is the proportion of equity financing. So this represents This represents S over B plus S. That's what is here. So if that's 40%, what is B over S? So we know that S over B plus S is 40%. And we want B over S. How should we find it? Does anybody know a trick to do this? So what you can do is S over B plus S is 0.4. So then B over B plus S is 0.6 because they have to make 1, right? So why not just take, if I took this and I divided it by this, wouldn't I get B over S because the denominators cancel? So I can just do that. It's a trick. Because if I put B over B plus S on the top and S over B plus S on the bottom, then these will cancel and I'll just get B over S. So that's how I do it. So you need to remember that. So you turn a ratio, a proportion into a ratio of equity, debt over equity, debt to equity ratio. Make sure you divide them right, Monsieur Sever. You did it. You did it upside down. Oh, I see. But I did the whole thing already. I've done it. And it's 1.5. So there's There's 1.5 times the equity. So this is RB, I told you. This is RB. Sorry, let me put red. So this is RB. RU is this one, that doesn't change. And we have 1.5 B over S. Let's see if we can get the right answer. So this is 0.16 plus 0.16 minus 0.66 times 1.5. What do you get? I made a mistake. It's 0.066. Okay, good. You guys did good. A little bit, some of them, be careful with your decimal places. So the answer is 30.1%. That's what you've got. Steadily increasing like we anticipate, right? We expect this to go up with increasing amounts of debt. So this is going from equity down, 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 more debt, till no equity, just debt at the bottom. Shall we continue? Any questions? Very good. You guys are doing great. So now, how do we find this one? Equity beta, I just need the equity, return on equity, and I can use cap M to find this one. So let's see. 30.1%, 30.1%, and So we can go back to this formula again. And we want to find the beta. So I'm going to erase what I have here. And again, this is 10% risk premium, market risk premium. This is what I want. This is 4%. And this one was 0.301, right? And now we can solve for equity beta. Very good. 2.61 is right. So I'm going to write that in. So are you getting the hang of this? Can I let you finish this? I just want to do a couple more. 2.61. So what you're seeing is the pattern that we outlined in the notes. As debt increases, there's less equity. The return to shareholders in the firm goes up, the expected required rate of return. And then their beta also goes up. Look at the increasing risk. It's over 4.8 over here. And as a result of that one going up, the debt beta goes up. Sorry, the expected return on debt in this case starts to go up, and the debt beta goes up, but it's nothing like the equity beta. The WACC stays the same, and it's equal to the return in the unlevered firm. Because the WACC stays the same, the weighted average beta stays the same. But to balance that, to make it stay the same, notice that the betas change and the expected returns change. Meanwhile, the return on assets is the same. And the beta of assets is the same. So this is outlining this pattern described here. WACC stays the same, equal to RU no matter what the debt to equity ratio is, and this is the ever increasing rate of return that as it increases, the beta of equity increases. All right, so this is what you're drawing out. This is what you're estimating, these calculations. So I've given you space below to chart your results. There's a table here. You can plot everything, and it should look like the plot in the notes. Okay, so you can plot with the percent of debt financing on this axis, and then the expected return on this axis. Percent of debt financing would be, I guess, 1 minus what's here. I didn't actually plot that in the solutions, but you should see the same pattern just looking at the chart. Did you want to do one more of these? Do you want to try this one? The next row, and then we'll get on to the next exercise. What's happening? Are you working on it? So you're going to use the same formula down here. Did you get something? All you're going to change is here and RB, right? Everything else will stay the same. So let's recalculate. So for this problem, you're told the proportion of equity is 20. Wow, very little. So 20% equity, that makes 80% debt. So I'm going to take 80% divided by 20%, which is just B over B plus S divided by S over B plus S, and those will cancel, so I get B over S. And then you get 0.8 over 0.2 is just, isn't that 4? So it's 4 times, it translates into 4 times the equity, right? So then this is 4. And then RB is over here at 10%. And when you put it all together, what do you get? Good, 0.4. Very nice. Okay, so you guys can do this. Some of you have already done it. This was a trick that I needed to teach you, and you see the general pattern, so you can complete that table for practice, all right? Should we go on to the next one? Any questions? Very good. Okay, so you finish this by yourselves, and let's see what's down below is the graph. So you can chart it, and it should look, like I said, like Proposition 2 with no taxes. Let's have a look at the next example. The next example is with taxes. So you make similar calculations, but now WACC is not the same. Okay, WACC is going to approach, in terms of the model, WACC should approach the return on debt. So these should be similar at the end. And so you can practice that one, I think, by yourself as well, and then make a drawing, sketch your results. And finally, what do we have here? I think it's supposed to say data from number 4, and fill in the table below. S is the market value of ABC's equity beta. B is the market value of ABC debt, and V is the total value of ABC. So it's just asking you to estimate the value of the firm, the market value, so you can practice that. Is there anything you want me to do here? You guys can finish that. So you can work with that. You can let me know if you have questions tomorrow. And any other day you can get back to me. I want to look at the other exercise, 35. What is this now? Oh, okay. So this is document 35. So let's take 5 minutes. You guys can get organized and pull out this document. Take a 5-minute break. Are you sure you don't have it? Sorry, I'm gonna check. I'm going to check. You should have it. It should be there. Download it. When I sent it yesterday, it came with 34, 35, 35.5, 36, 37, 37.5. And then today I sent the solution that we did to the problem yesterday. Verify. Jeffson? Yes, please check. You might not notice because I sent you several documents. Very good, Jeffson. I'm glad you found it. Okay, shall we continue? Okay, so you're told M&M model with no taxes holds, right? So this is the case where a value of the firm does not change and the WACC stays the same no matter how much debt is issued. There's no default risk and there are no taxes. The risk-free rate of return is 4.8% and the expected rate of return on the market portfolio is 16.2%. So let's finish this today and then let me see, that's M&M with, okay, and that's with taxes. Okay, you have to be careful with taxes to include the taxes into your formula. So I'm just going to open up my solution set so I don't make any mistakes. Okay, so we want to get the beta of equity. And we have here the risk-free rate, so this is RF. (4.8%). And we have the expected return on the market portfolio, so this time they gave you ERM. Sometimes I use capital, sometimes I don't. I try and be consistent, but I never am. I'll use the lowercase here. RF. And then what else? Expected return on the market. And then all equity firm is a market value. Okay, so they give you, it's all equity, and S is equal to 600 million. The return on investment in DBC stock is 19.05%. So this represents the return on equity. This is RS, ERS, or ERS. Either of those. So what's the beta of equity then? You have the return, you have the information for the CAPM. So let's apply the CAPM. The CAPM says R RS, or expected return, is equal to RF plus the beta of S times RF minus, sorry, not RF, expected return to the market portfolio minus RF. So basically the market risk premium. So let's plug in what we have. We have this, which I said was 19.05. RF is 4.8. This is 16.2 minus 4.8. So you can find beta. So you have this, you have this, you have this, and you have this. So solve for beta. All right, let's see. Nope, that's not the answer. Try again. Try again, Monsieur Sever. So let me clean this up. So what we have is 0.1905 equals 0.048 plus, well, we want the beta S, and then the risk premium is 0.162 minus 0.048. So beta S is equal to 0.1905 minus 0.048 divided by the market risk premium. Very good. This is going to give you 1.25. Okay? So we need to make these assumptions for this to work. But if we know the expected return through the CAPM, we can estimate the risk inherent. So it's more risky than the market portfolio, right? 1.25. Sensitive to the market returns. Let me know when you're ready. Oh, you guys are silent. Anybody else? Oh. All right. Okay, so we're ready to go on. How are others doing? You ready? Are you ready? Are you ready? Are you ready? Okay, you're very quiet, so I'm just going to continue. I'm waiting for comments. All right, let's continue. So now, assume the company converts 240 million of its equity to 200 million of debt. So it was 600 million, so now what happens? So B will be 240, and that leaves S from 600 to down to 40 is equal to 360. So S is 360. And the debt, RB, is 7.5%. And now what is the market value of DBC? Okay, so now we've issued debt. What happens to the value? What did we learn in the model with no taxes? So from Proposition 1, the value of the levered firm is still equal to the value of unlevered firm. So it's still 600 million. If Proposition 1, no taxes. So that should be the answer. That's the theory. But let's see what happens. Let's calculate the answers to the other questions and then look at the situation with taxes. What is the return on equity now? So remember that when we issue debt, we have both bondholders and shareholders, and the shareholders demand a higher rate of return, right? Equal to RU plus RU minus RB times beta, or B over S. So we can sort this out. RU was the original 0.1905, but this has to increase by 1905 minus RB was 0.075, and then B is 240 divided by S, which is 360. So we're just going to use the same formula. So the value of the firm didn't change. It's part equity and it's part debt. But there's no change in the value. So what do you get? The result here is 26.75%. So that's a lot. Very good. Okay, now we go to the next question. Now using the capital asset pricing model, right? Well, we want the WACC and the weighted average beta. Sorry, we have to do the, yeah, we need to find the WACC. Well, what's the WACC? We know what the WACC is, right? Because with no taxes, the values are the same, and so are the returns. Now, the unlevered was 0.1905. So if this is the same, and the return to stockholders changed, the return to shareholders required changed, and the return to bondholders is 7.5. If we were to calculate the weighted average cost of capital, we should still get the same return as we had originally. You can verify it. We can check. The theory says that's what's going to happen, so we could verify. And you get that WACC must be S over S plus B RS plus B over S plus B RB. And remember that taxes are 0, so there's no effective taxes. So if you put this together, we have the results for S and B up here. So S is 360, S plus B is 600, right? And this is 7.5. If you put all this together, B is 240, S plus B is 600, and the return to debt is 0.075. If you add all of this up, you should get no, this is not RS. That's not RS, that's the result, sorry. RS is the one we calculated here. And that's 2675, so 0.2675. And you should end up with the same return. It shouldn't have changed. Sorry. So did we answer the question? So what's the so the final, we wanted to get the WAC, so we got that. And what's the weighted average beta? Well, if the WAC stays the same, or the return to investors stays the same, then the beta must stay the same. Okay? And the beta was 1.25, so it stays the same. In the solutions, I've verified a lot of calculations. Different ways. I made different calculations, so you can see how many different ways you can do this. Very good, Monsieur Sever. Thank you. But the theory already gave you the answer, okay? So you know these are the same. So it must be the case that the beta of S, or the beta of WAC, say beta of WAC, it's beta of assets. That's what this is. This is the R of assets. And because of the theory, these are the same. Let me square off. So the beta of assets must stay the same. It doesn't change. If the return doesn't change, the beta doesn't change. Because of cap M. I use the same relationship. And that was provided in the problem above. The information here, remember the first question was find the equity beta, so it doesn't change. Okay, questions. Are you ready for the next part? The next part is going to be with no with taxes. We're going to allow for taxes. Very good. So those are the two results. So you should practice doing this different ways, understanding how you go from risk to return and how the debt changes things. So capital structure is the mix of debt and equity. With all of the assumptions we made, we can show that the value of the firms doesn't change if you add debt. As long as there's no taxes, you assume perpetual cash flows, and there's no default risk, right? And the borrowing and lending at the same rate by firms and investors. Are you ready for the next part? Now we're going to introduce taxes. Introducing taxes with CAPM true and assuming the M&M model holds. MM1 or MMI is a corporation financed with debt and equity. Its $100 million debt is in the form of bonds that pay a coupon rate of 10% per annum, paid semi-annually. MMI's corporate tax at a rate of 40%. A financial analyst has estimated that if MMI were an all-equity firm, it would have a market value of $360 million, and that the return on investment in MMI's equity would be 19.25%. Find the market value of MMI. So I'm going to let you try that. I'm going to take a little break. Get your questions together for me. I'll be right back. Okay, ready? I think it was more of a 10-minute break. Okay, let's continue. Any questions? So now we're going to deal with taxes. And we have information provided on it's $100 million debt is in the form of bonds. And you have information here about the bonds. And you're told about the tax rate. So B is 100 million. Right? And the bonds pay 10% coupon rate per annum semi-annually. So you need to get the rate out of this. How do we get the rate out of this? Well, we know that the price is equal to okay, so wait, C is 10%, but we have to divide that by 2 to get the value. 5%, because this is a stated rate. So what we need to do is at some point we'll have to deal with this information, right? I believe we will have to deal with it when we determine the return to bondholders in a later part. But let me write the information now so it doesn't surprise you. So this information means that the payment will be 1,000 times 5% or $50. So it would be $50 over RB 1 minus 1 plus RB to the how many years? It doesn't tell us how many years. So we'll have to use T plus the face value of the bond, 1,000 over 1 plus RB. So this is when we're ready to find what the return to bondholders is. We'll have to solve this problem, okay? But that's not right away. Right away, all it is that we have to do is use the theory. What is the market value under the leveraged capital? Well, we learned that the value of the firm that's levered with taxes is the original, but marked up by the present value of the perpetual tax savings, known as TCB. So all I have to do is take the original information and it says here, an analyst has estimated that if it was an all-equity firm, it would have a market value of $360 million. Let me erase this for now and highlight this information. Okay, so that's the VU, 360 million. They've estimated that if it was an all-equity firm, it would be valued at 360 million. But 100 million has been issued as debt at a tax rate of 0.4. So you can figure out the value of the leveraged firm. So the question is why, if I think 360 million is S, isn't that correct? 360 million is S, but which S is the question? Actually, we don't need that right now. All we have to do is figure out the market value. So did you try to add S and B? Well, what is S then? That's the question. Because S would be changed by B. So this is why we have this formula. This is case 2. I call it case 2. It's where you have all the assumptions but you have taxes now. So it's a 400 million. Okay, now if we try to do this with, S plus B, we would have B of 100 million, but we don't have S. That's the problem. We have this as the original S, but by adding B, remember, S changed, right? So we need to know the impact. Now we want the market value of equity. Okay, so let's see. Well, we can figure that out because it changed. Now that we have the value, because value of the levered firm is S plus B for the levered firm. And that's 400 million. And S is what I want, and I know that the debt for the levered firm is 100 million. So we know SL is now 300 million. We didn't know that before. We needed a way to find the value of the firm with debt. See how useful this is? Now you want to calculate the WACC. You want to get the return to the average investor in the firm. You want the return to the average investor. What did the theory say? Well, it's going to change now. It didn't change when there were no taxes, but now it's going to change. So what's the WACC going to be? The WACC will be the weighted average cost of capital, which is S over S plus B, RS, plus B over S plus B, RB, times 1 minus TC. So for the levered firm, what do we know? We know S is 300. We know the value is 400. We know RS, do we know RS? RS, let me see. Okay, so yes, we have the information on RS here as well. Let me erase what is no longer important. So as you see there at the end, it tells you RS. RS. Equity would be 19.25. So this is 19.25. And then B would be 100. S plus B is 400. And now we need RB 1 minus TC. 1 minus TC is 0.4. So you see now we have to get RB. And how are we going to get RB? I have it up there. Oh, wait a second. Sorry, that RS is the old RS. Let's clarify. This one is the one that was given was for the unlevered firm. That's right. Let me highlight it again. If it was an all equity firm, it's 19.25. That's the old one. But this is wrong because this is, I need the new one. Right? So I have to find two things. I need to find RS and RB to solve this. Oops, sorry. My iPad. Okay, any ideas? Notice what's missing to solving this problem is the T, the RB. Unbelievable. It's information missing. There's information missing. It should be 20 years. It should tell you. Maybe I erased it somewhere. So I'm going to add the extra information, or you cannot do this. Let me say that again. Sorry, let me fix that. I'm going to say note. Bonds are 20-year par value bonds. So you get some practice from the old material. You still need it. You can't forget anything. That's right. That's 0.75 and that's 0.25. That's correct. Don't forget the 1 minus TC. Jeffson, don't forget this. Okay, so if they are 20-year par value bonds, I already figured out the payments are $50. And par value means that the price is 100. 1,000. And I want to solve this expression for 40 periods. Because remember, bonds are semi-annual. So what do we have here? We have RB is an effective semi-annual rate here. And I said to put in a half here just so you remember. That's not what we need. We need the effective annual rate. So keep that in mind. And also because it's 20 years, that's the same as 40 semi-annual periods. So now that we've done that, we're ready to use our calculator to solve this by putting into the calculator the years, 40. The interest rate is what we want, so we won't put that in. Then we have the PV, price. And the payment, that will be a negative because that's purchasing or purchasing the bond. And then in the calculator, we also put the payment of $50, which we receive if we hold the bond. And finally, the $1,000. But we already know the answer here, right? Because for a par value bond, coupon rate is equal to the interest rate or yield to maturity. I'll call it the yield to maturity. Or I'll just say interest rate because That's how we did it in the notes, right? We did C equals I. So if you do this in your calculator, you will find that the interest rate will be 5%. Okay, where did I get the 1,000 is it's not written. Unfortunately, it must have gotten erased in the question paper. So I added this statement. Harry. Jefferson, you forgot the 1 minus TC. That's all. So when you solve this, you figure out that RB will be 5%, same as the coupon rate over 2 was 5%. They have to be the same. Okay? Questions? You guys are asking good questions. Okay, so par value bonds means the price is the same as the face value. That's what par means. All right, so what do we have here? So I have that the half-year rate, the effective semi-annual rate is 5%. Now I need to convert that. It needs to be an effective annual rate for the formula. You need to remember that. So you need to take 1.05 squared minus 1 to get the effective annual rate. And that is RB. Oh wow, we're coming close on time. 1.05 squared minus 1 is 10.25. So this is 10.25. Next, you need to get RS. The way you'll get RS is using that formula that we did last time. So this is for RB. Sorry, that's not what I wanted to say. This is RB 1/2. So I'm using this notation. You can put this in there instead. The result is the half-year rate, but you need for the formula here has to have effective annual rates. So I'm going to make a note. I'm going to make a note. So that's the effective annual rate for B. Now I need the effective annual rate for RS, and I'm going to use RS equals RU plus, remember, RU minus RB, B over S, but now with taxes, I add in the term 1 minus TC. And this is how I estimate RS. So this is a long one. So RU was the one that we were told in the question. It's 19.25, okay. So that's 19.25. And then it's 19.25 minus RB, 0.1025. Notice how I need that. And then B over S, we figured out that we can use 100 over 300, and that's fine. That will be the same. And then 1 minus 0.4, 1 minus TC. And then you'll get that answer. It's a very long process, so you need to practice. Don't get stumped. You have some answers for me. Very good. 21.05, very good. Okay, so you guys can practice this. I'm going to let you go. Tomorrow, I'm going to ask you to complete this because you have RS for the levered firm. You have RB, and now you can calculate the WACC. So that's where we're going to start tomorrow's class, okay? So now find WACC. And we're going to do the last page is where we actually estimate optimal debt. Okay, so that's what we're going to do tomorrow. And I'll answer any questions you have. But other than that, I want to say good night. We survived. We're all tired. I want you to have a good rest. And let me know tomorrow if you have any questions. So work on this before tomorrow. Okay, thank you, Samuel. Anouk. So just note that I had to add this statement, or you can't solve this problem. I don't see that information is available. Practice. Have a good rest. Always bonsoir. Hein? Bonsoir. There. Have a good night. Good night. Bye-bye. Excellent, Harry Charles. You got the right answer. Very good. Good job.